our main episode of Question and Answer with Cole and Associates. The intention or the objective of this is to actually enlighten each other on pertinent issues in practice. In this month's episode, we will be considering 4 topical areas in various aspects of our practice. Of course, we look at something in audit, financial reporting, taxation, and other aspects that relate to human resources generally. I'd like to start with audit today. In the course of the month, we did make a publication on auditing, specifically on ISA 450. This particular standard is very key to every auditors because in the course of their audit process, there are times errors are made, whether intentionally, judgmental, or projected wise. And it is very essential that these errors are appraised to or evaluated, as the case may be, to see whether it will in any way distort the intended use of the financial statement. You will also agree with me that auditors don't prepare financial statements. It's not part of our responsibility. But this financial statement, in accordance to the provisions of CAMA, is expected to be prepared by the management. Management has a sole responsibility for preparing financial statements. What then is the role of the auditor in this financial reporting process? The auditor is seen as an independent body who has a primary objective of expressing its opinion on how well the management has done or performed their function, right? The auditor, in the course of doing this, will be benchmarking its review of the financial statement with certain definite or defined guidelines. It will benchmark its review in line with what is legally expected of the management to have done or complied with in the course of preparing the financial statement. And I'll take an example of that. If the management manages a business in the banking and other financial industry, it is expected that every preparation or presentation therein is in line with what the regulator has provided as guideline, in addition to the provisions as contained in Companies and Allied Matters Act. So auditors check to ensure that disclosures and presentation in the financial statements are in line with what our laws has provided. Somehow one can tie that with a definite standard which we'll be looking at in future, which we call ISA 240. But for the purpose of today, we are looking at instances where auditors has checked the legal compliance of presentation and disclosures in the financial statement. It has also checked the presentation and disclosures therein to be in line with what our accounting standard requires of any organization operating in a specific industry. So the relevance of today's standard is specifically tagged ISA 450, which emphasize the evaluation of potential misstatements during the audit of a financial statement. So if an financial statement is undergoing the audit, before the conclusion of that audit, the auditor is expected to evaluate whether there is any misstatement contained in the identified in the financial statement that is being audited. So join me in deliberating on this today is my colleague Toluwanimi Makide. Toluwanimi, are you there?
Yes, sir. I'm here, sir.
All right, my audience would like to know what is the meaning of misstatement as contained or introduced by the standard ISA 450.
All right. So when we're talking about misstatements in line with ISA 450, like Paul has rightly mentioned, the management is responsible for preparing the financial statements of a company before the auditor comes in as an independent body to review what has been done. Right. So in a case where there is discrepancy between the reported item in the financial statement and what is required by the applicable financial framework or the standard that the auditor is following in carrying out his audit engagement, those discrepancies are referred to as misstatements. So an example can be in a case whereby the company has reported an item, let's say inventory, for example, as 50 million in their books, right? And following the standard that relates to inventory, you as the auditor now finds out that has been wrongly presented by the management, and let's say the figure is supposed to be like 30 million. That means there is a 20 million misstatement in that case. So the discrepancy or the difference between what has been reported in the financial statement and what is required for that figure to be according to the accounting standards that we are following as the auditor. That is what misstatement is.
All right, Nimi, thank you very much. But from your explanation, does it mean misstatement has to do with numbers alone?
No, misstatements can be qualitative or quantitative, right? Misstatements can also relate to disclosures, that is maybe written disclosures and not just figures or amounts alone.
Okay, so I've seen in instances where there is a debate whether if some disclosures, something are regarded as disclosures and some things are regarded as presentation. What's uniquely is the differences between these, so that my audience will know if they find themselves in the position of an auditor reviewing financials, they will be able to decipher what constitutes disclosures as being distinct from presentations.
All right, to the best of my understanding, I would say that disclosures are more like supporting information, right? Say, for example, let me give an example, right? We have a client that bought an asset, and this asset, maybe during the course of the financial year, has already been put down as collateral for a loan or something. A disclosure in that case would be you stating as the auditor in the audited financial statement that particular asset has been put down or has been used as a collateral by the management in getting a particular amount of loan from a loan company. That is a disclosure because it provides more information to whatever figure, whatever presentation. Well, I would say figures are presentation, right? We have, it can be your assets, it can be your liabilities, it can be your income, it can be your expenses. When you have figures that state what has gone on during the year in those different assertions, right? So that I would say is presentation, but disclosure is what gives further information or better understanding of what those figures represent in the financial statements.
So if I get you right, it then means that if you pick an audited account, the components of that audited account that relate to statements of accounting policy, note to the account, will likely be regarded as disclosures.
Yes, sir.
All right, thank you very much. Could Also, is it possible that misstatements also occur in terms of classifications of accounts?
Yes, sir, that's very possible. And to speak more on that, I'll give an example rather. So if we have, I'm looking for a very good example. Let's say we have a receivable amount, right? That is, let's say a prepaid insurance amount, for example, right? And that has been wrongly classified as, let's give example of HMO. Let's say we have prepaid health insurance, right? That is a wrong classification. And when the user of financial statements or whoever is in the financial statement is going through the figures, the person will be seeing an overstated prepaid health insurance. Meanwhile, the what was the first example I gave? The prepaid I've forgotten the very first example I gave. So the other prepayment has now been understated by whatever amount was supposed to be there initially. So that is a misstatement in that case based on classification.
Okay, from experience, I've also seen instances whereby there is a context around how rent expense should be reported in a particular, on the face of the account. So if you have an instance, you are the auditor on a particular engagement, and you have an instance whereby a short-term rent, the portion of it that have been prepaid, making reference to something similar to what you just mentioned, has then been reported as a right of use of assets, but on the component of the non-current asset portion of the statement of financial position. Could we say that is a misstatement?
Personally, I've not come across that, but I would say that is a misstatement because you are misleading whoever is looking at that information, right?
Okay, thank you very much. Thank you very much. That is very in line. Then the next thing is that when auditors identify a misstatement, or whether in terms of presentation or disclosures or classifications, right? What then do we have to do? Do you say that every restatement, every misstatement will warrant what sort of action from you as the auditor?
Okay. All right. So the standard gives us 3 requirements to follow, right? The first is to accumulate it. You accumulate the misstatement. Secondly, you evaluate the misstatement, then you communicate the misstatement with the management or those charged with governance. So the very first one now, in accumulating the misstatement, that is where you look at the misstatement you've identified in the course of the audit engagement, either individually or in aggregate, if those misstatements are now material. Right? So it's possible that you are auditing a 100 billion kind of company that they have revenues running into billions, and you see misstatements of 100 naira, 1,000. In the case of that kind of company, that misstatement is not material, right, for just that individual figure. And you can see a misstatement also in that same company that runs into over 2 million, right, and that is repeated in many classes or in many accounts. So if we are looking at that kind of misstatements in aggregate, it's possible that it would hit the materiality threshold that you set at the beginning of your audit engagement. So in that case, you are supposed to get all the misstatements that you've noticed or you've observed, accumulate them. Then you now make your evaluation and look at it that will this misstatement or all the misstatements, would it influence, at the end of the day, would it influence whatever decision the users or the financial statement is going to take based on what is being reported? Or you will also look at the case whereby the misstatement might affect your opinion also. So that also links us to different standards just beyond just the 450 in this case. And in communication also, once you've noted these misstatements, make sure you communicate on time, if it's possible, immediately with the management or whoever is in charge, so that they can also maybe check through their books to see or agree or disagree with you, whether they stand with your opinion that those misstatements that you've identified are actually material to their financial statements. So,
Yes.
and
All right.
right.
Okay. That will lead me to the next question I want to ask you, because you were, in the course of your explanation, you link misstatement with materiality, and I have the understanding that ISA 450 did not specifically address what constitutes material sum or not, right? It also did emphasize that misstatement is not the same with materiality. How would you, as the auditor, ascertain what is material? Because you want to know, you had earlier said that what is material, misstatement that is material may or may not affect or warrant you to qualifying or making a refinement in your audit opinion. What advice would you give to young auditors here or aspiring auditors here who might have identified, or in the course of their work, identify misstatements? How will they how will they benchmark it with materiality and the likes? What reference would you give to them?
Okay, thank you. Like you rightly mentioned, the ISA 450 itself does not mention materiality, right? That is within the purview of ISA 320. And for every auditor, at the beginning of your audit, even during the audit and even at the end, you're supposed to prepare your materiality, which would, in a way, help you to determine the scope of what you are going to cover during the audit engagement. In a case where you are auditing a very large company that has a lot of information, right? It's not possible for you to do a 100% check on every single transactions that they have. So your materiality, in a way, helps you set a benchmark that, okay, any figure above, let me use an example, any figure above 5 million, right, you are going to make sure you get sufficient evidence for those transactions. You are going to make sure that they are reported in line with the accounting standards and all. So in a case where you now discover misstatement in the course of your audit engagement, and say, for example, in aggregate, those misstatements are less than your materiality threshold, in that case, you will say that it is not material because it doesn't, it hasn't yet gotten to the threshold you had set initially at the beginning of your audit. But another thing for us to note is, it's possible that when you were setting your materiality at the beginning, you were not privy to some information that could have affected your materiality. But now that you have seen some misstatements, it is now left to the judgment of the auditor in this case to now determine if those misstatements that have been mentioned would warrant revising the materiality that had been initially set, and also if you have to perform extra audit procedures in ascertaining that those misstatements that you've now noticed would not be material to the financial statement.
Yeah, thank you very much, Nemi. Also, I'll still pick you from there. In the course of your audits, for the benefit of those who have just joined us, we are still discussing ISA 450, and this is in line with our mandate to always pick just one concept in either auditing, financial reporting, taxation, or even HR, and discuss it for the entire month. So what we are looking at this month in relation to auditing is ISA 450. ISA 450, as we have earlier introduced, addresses one unique are one of the unique processes that auditors are expected to carry out in the course of their audit of financial statement. The standard, as I said, is ISA 450, and it is tagged evaluation of misstatements during the audit of financial statement. Let me back to you. You are in the course of auditing a financial statement, and after you carried out your evaluation, you did identify a number of exceptions that you would expect the management to address. You have communicated these to the management, and you have a feedback that they are not willing to addressing that concern. What will be your reactions or your action as the auditor?
All right, sir. So in a case whereby the management has said or stated that they do not agree with what you had stated as material misstatement, and as we all know, the objective of the auditor is to form an opinion on the financial statement, right? So now you have to determine if such misstatements that has been refuted by the management would result in you modifying your opinion. That is going to link us to ISA 700, forming an opinion and reporting on financial statements, right? So now you have to determine that this misstatement, would it lead to maybe an adverse opinion, or would it lead to whatever opinion it would be based on the circumstances that you have in that case. And in that case also, you also have to communicate with the management that, okay, based on these facts that we've gotten from you and the communication we've had, this and this and this are the actions that will be taken if you refuse to correct such misstatements that we've already presented to you. And you can also communicate with them the kind of opinion that they will be getting as a result of such refusal or such objections to the misstatement.
Okay, one very important question again. Should you have identified certain misstatements and the management resolved not to adhere to your position on a particular matter, is it possible that could stall the audit?
I think it depends on the sort of misstatement, right? If it's something that is fraud related, that would involve maybe the legal authorities or something. But most of the time, it is usually ends up in audit opinion modification. I would not say outrightly that it will lead to putting an abrupt end to the audit engagement in itself, unless under very special circumstances.
All right, thank you very much. And one person had asked here, please, what is the basis of setting materiality threshold for the very first time audit of a company? I think we have taken ISA 320 before. We did emphasize that there are various approaches that you must follow in line with the provisions of the standard. And it is not just setting the threshold, but looking at attributes of that very company and which one will most likely be suitable for determining a reasonable threshold for materiality. For example, if you are auditing a company that is profit-oriented, using profits before tax or after tax, as the case may be, or using profit on its own, as the case may be a way to to ascertaining the appropriate percentage of that profit that will be established as that will be used as materiality threshold. In that section too, maybe the regulatory arm would just share with him a link to that recording we had then. We also did emphasize that when you are ascertaining the materiality threshold according to that very standard, it did distinguish between what is materiality itself and what is performance materiality, what is specific materiality, and what is clearly trivial. We have addressed all of that in that very section. But if you still need more clarity on this, please feel free to still ask more questions. But I believe that would have addressed your concern. Let me back to you. My very final question to you before I move to another aspect of our conversation today is what advice will you give to auditors when as a suitable approach to adhering to ISA 450?
Okay, I think what I can say to that is to adhere to ISA 450, right? There are steps that you have to have taken before reaching that point. You would assess your materiality, assess your response to risk, your risk of material misstatement also. And in a case after which you have gotten to the point of now getting to see that there were actually misstatements in the financial statements, it's very important that as an auditor, you remain independent of the management, right? Because there's a probability that the management might try to cajole you into just rounding up the audit or just trying to just close out the whole thing so that they can move ahead with whatever it is they want to use the financial statement for. It's always important to note that as an auditor, we have an integrity to uphold, and also we are responsible not only to the management, we are also responsible to users of the financial statement. So we should make sure that we do what is right according to the set guidelines and standards that we have in both the accounting standards and auditing standards, to ensure that we are actually presenting a true and fair financial statement or report to whoever will be using the financial statement.
All right, thank you very much. So what I could deduce from what Nene had said is that for you to be an exceptional auditor, you need to have a good understanding of your accounting standard. You must also have a good understanding of your auditing standard. And looking at the organization you are to audit, you must know definite regulation that applies to them and ensure that you follow the guidance as provided by the standard and also in line with your firm's regulations or policy to ensure that you have done the right thing. Please, it is our view to support everyone who may have challenge in this regard, and that is one of the reasons for bringing this up, that when we draw your attention to some of the things you need to know, the responsibility will then be on you to make sure that you build on this insight. Get copies of write-ups on this topic, in addition to the actual standard itself, digest it, and let's take the conversation further on our linking page. So taking us further on this particular episode, we had also identified a very, very important aspect of taxation. And this month we have put up a very interesting topic, which is the effect of exchange on transfer pricing. So joining me in discussing that this month is my colleague, Abiodun. Abiodun, are you there? My audience would like to meet with you.
Yes, sir. Good evening, sir. Good evening, everyone.
Yeah. So to lay foundation to it, can you please briefly explain what this entails. Why is it relevant to transfer pricing? Why is transfer pricing itself? Very briefly.
Okay, so to start with, I would like by first stating the fact that Nigerian as an economy is an open economy. So what that means is that we don't survive as a closed economy. So we survive by interacting with others in the other space. So also as a company, this aspect of being an open or closed economy also spans through to a company. As a company also survives by interacting with other companies, having transaction with other companies. So as a result of this, there could be interactions between one company and the other across different jurisdictions. So that means as a company here in Nigeria might be transacting with company outside of Nigeria's. So transfer pricing was being brought into place in order to ensure that, okay, before I even move forward, I would like to explain a particular terms of transfer pricing, which is the related parties. So related parties or control transaction are people that have control over decision making of a particular company. So let's take for instance company A and company B. Company A is being owned by same directors as company B. That automatically, the presence of the same directors between company A and company B automatically makes both company a related party, because the decision making of that particular shareholder in company A, that particular shareholder also have authority or power to make decision in company B, and this decision can affect the operational activities of both companies. So in that regard, company A is a related party to company B. So another ways where we can have related parties is if companies are being owned by the same parent company. That means company A bets company B and company C. So company A is having a huge or a large shareholding in both company C, B and company C. So in that way, company B and C are related party, company A and B are related party, company A and C are also related party. So transfer pricing came into view in order to ensure that transactions between these companies known as related party are being subjected to the right tax, most especially transactions that are being done across the border. So that what that means is that if, let's take for instance, company B is not a Nigerian company and company A in instance is a Nigerian company now, if company A happens to have any transaction with company B, the transaction between company A and company B, let's say a particular payment is being made across both to company B, knowing fully well that company B in this regards now is not a Nigerian company. Nigerian government don't have the right to suggest that particular sort of income or whatsoever company B is getting from that transaction done with company A to tax. So because of that,
Betty, let me even hold you there. Before we get to all those other technicalities, I want to be sure that the audience actually have a good understanding of what we are talking about. As I said earlier on, we're looking at the exchange effect on transfer pricing, right? And Biodo has been able to establish the fact that transfer pricing will come to play where there are related entities. So as an accountant, how do we identify that a company is related? And in our words, one of the things that she has put forward is the fact that there is common ownership across various companies. Because there is common ownership across various companies, there is a potential or possibility that a company that has a higher shareholding may exert certain influence or control over the other. Because of that, there are potentially a related party. And because they are potentially related party, there is also a likelihood that when the transactions are being carried out, the transactions or the pricing of those transactions may not be at arm's length, right? That's what she's trying to established. But Biodun, can we then link? How then do we justify the link with exchange? What relevance has that got to do with transfer pricing?
Okay, so if I get your question, you're asking what's relevant as exchange rate has to do with transfer pricing, right?
Yeah.
Okay, so haven't been established that transfer pricing arises from related party transactions, which the TP, that's the transfer pricing regulation, also refer to as controlled transaction. So as the effect of exchange rates on transfer pricing transaction is that exchange rate affects the transaction itself. So exchange rates between companies affect any transaction you might be having between companies. So let's take, for instance, company A is an abroad company and company B is a Nigerian company. Company A has purchased something, company B has purchased something from company A at a particular exchange rate, but probably the payment was not done immediately. At the point of payment, exchange rate has either increased or reduced or the like. So the effect of that exchange rate has already affected the transaction, and this can either increase or decrease the amount of money country B is liable to pay to country A. And let's not forget that the major reason why government is interested in transactions being carried out between this company is because to avoid what we call basic erosion or profit shifting. Company B has the tendency of trying to shift their profits from Nigeria when it would have been subjected to tax to other companies. Don't forget, I made mention initially that transactions done within company A, Nigerians don't have the ability to subject it to tax because company A is now outside the jurisdiction of Nigeria. So because of that, the Nigerian government, in order to put into guard those transactions that could have happened between company A and company B, they've ensured that company B itself, being a Nigerian company, must file what we call the transfer pricing return. So the transfer pricing return is just basically talking about the declaration of the transaction that has happened between you, your Nigerian company, and you, between the Nigerian company and whatsoever control transaction. So
all right. Sorry, I had to hold you from there. I know you are so much eager to dish out so much, but at the same time, I don't want to leave our audience carried away. You had earlier made a very important point. I've noted it down. The base erosion profit shifting BEPS is a concept that we'll be discussing maybe in a couple of months' time. It's also something very topical. But there is usually this misconception about transfer pricing. People often think, I've had conversation with some clients and I made mention of transfer pricing risks in their operations, and there is this reaction that, the tax authority or the government has come up with another form of tax against transfer pricing. Is it true that TP is another form of tax?
Okay, sir. So TP is not a form of tax. TP is just basically a declaration of transaction held between controlled parties, and controlled parties in this instance is related parties. So you are just basically declaring the transaction that has happened between you and your controlled parties. So whatsoever the government now decides to make of those information is left to the government. So it's not like you're paying additional tax, it's just majorly a declaration.
Thank you very much. To our audience, as you've heard, transfer pricing will only occur where organizations or business entities carry out transactions with parties that they are related to, and the relations, as we have explained, is most definitely in terms of these entities that are separately incorporated but they having common ownership, right? if you have to go into financial reporting, the ownership interest there may be an associate interest. It may be that which constitutes that leads to a full control, right? But for tax purpose, it has also been established that transfer pricing is not another form of tax. Government just want to ensure that there are possibility that if you are related, you might not have carried out related party transactions at a price that you will have done with other entities that are not related to you. Therefore, they want to be sure or have put in policies in place to ensure that whatsoever you have done with your parties that are related to you are done as though they are not related to you. So they will expect that alongside with your corporate tax returns, you file your TP returns as Biodun has mentioned, and you are to disclose what you have done with related party and what are declarations on that, disclosures and the declarations in that very regard. The other will be coming back to you. I don't know whether Alex is here.
Yes. Good evening. Good evening, everyone.
All right, so one other area that we'll be looking at today is relation to financial reporting. And today, we have also identified one big area, which is IAS 21. But before we go into that, please, if you have any question about what we have discussed thus far, you can either indicate by show of hands or use the chat box. Please keep your questions coming, or even if you don't have a question but you want to contribute, please feel free, just indicate and we'll give the opportunity to talk. We want to, as possible, make it as engaging as it could be. Alex, I'm ready for you. A very simple and direct introduction to our audience on IAS 21. Review.
Okay, thank you, Cole. Good evening, everyone.
Alex, you are far from your mouthpiece. I need to speak to it much more.
Okay, good evening, everyone. I believe you can hear me. Is it?
Yeah, we can hear you. Go ahead.
Yes. So, IAS 1 speaks to the effect of changes in foreign exchange currency, and it's almost inevitable for businesses to carry out their day-to-day transactions without having anything to do with the foreign exchange, either by way of transacting their day-to-day transactions or for the sake of reporting, they require the conversion of their financial statements to a functional currency or a presentational currency just to attract investors. So what does IAS 21 look out for? So IAS 21 outlines how to account for foreign currency transactions and operations in the financial statement, and also how to translate financial statement into a presentation currency. So,
well, hold on, sir. Does it mean that if I operate a company and I don't have any reason to carry out any of my transactions in the currency other than Naira, will this standard still impact my financial reporting?
if you do not, okay, if I get you right, you said if it is that you don't have any other options but to engage in only Naira.
Let me put my question again. My point is, if all I do up to my financial period were all done in Naira, being a Nigerian company, will I still be impacted by this standard?
The only way you could get impact on the standard is at the point of you disclosing that all transactions are presented in the Naira currency, and that is due to the fact that it is based on a functional currency. You use a functional approach to account for your transactions. And because it's functional, you are taking certain considerations, that is major operations, major sales, major revenue, major primary economic environment. You're taking those factors into consideration. So that's what makes Nigeria, the Naira, being that you're operating in Nigeria and every of your activities sits in Nigeria. So you are expected to report based on that functional currency, Nigeria. So it's expected that you report your transactions in Naira. And again, the fact that the other way it could impact is that since all your activities are in Naira, it means the users, being that they are all squarely within the environment of Nigeria, you have to make your financial statement very, very understandable, very readable to these users. That is, the users could be the government, the regulators, the FIRs, the tax authorities, and the banks or other investors within Nigeria. Thank you
very much. Unless I did emphasize that whether you're operating in, irrespective of the currency you're operating, everyone is still impacted by the standard, because as long as you are operating within Nigeria, the monetary currency in Nigeria is higher. Therefore, the standard emphasizes that you should present your financial statement. He had also mentioned something relating to functional currency. Alex, would you mind differentiating between what is functional and what is presentation currency? Is Alex there?
Okay. So for the term functional currency implies the currency of the primary economic environment in which the entity operates. So what are these primary economic environments? It has to do with if it's economic, it has to do with inflation, exchange rate, government policies.
No, Alex, you didn't get my question. My question is, you did mention that because of your explanation, you mentioned something relating to functional currency. Maybe you must. I think there's a noise from your background. You did mention something relating to presentation currency, which is the currency at which your financial statement must be prepared, right? Then there is another one which you call functional currency. That is the currency at which you have carried out your transaction. So if you had carried out your transactions in Naira, then your functional currency and your presentation currency will still be the same. But it's possible that you had carried out your transaction in a currency other than Naira. So if in that instance you had used Canadian dollar, then Canadian dollar will be your functional currency, while your presentation currency will then be in Naira, right? So the standard had then made guidance to how that your functional currency will be translated to Naira. But I'll be coming back to you. I want to confirm if anyone has any question. Don't forget, this particular episode is anchored by KCP, and it is part of our commitment to promoting accounting education, tax education, and audit practice in Nigeria and beyond. We have marked certain topics across all of these disciplines. In auditing, we have identified one of the very germane ISAs, which we call ISA 450, right? And discussing that with me on this has been Tolu Animi. We have also briefly discussed about the effect of exchanges, foreign currency on transfer pricing with which with whom we had that conversation. Joining me on that is Abiodun. Then on IS 21, it is Alex. I don't know whether at this point you have any question on all the things we have discussed, or you have certain burning issues that you had encountered in the course of your work or your personal study, or even in the course of you reading some of our materials online. This is the time you are free to ask in those questions. You can either use the chat box or you signify by a show of hands. Any question before we go ahead? Please, let's make this conversation as engaging as possible. Any question? Is there anybody who wants to ask any question? Joel, do you want to ask any question? Okay. Anyone? Do we assume that everybody understands what we have discussed thus far? Okay, somebody just posted a question. How can companies ensure compliance with transfer pricing regulation while minimizing their tax liability? Abiodun, would you want to address that question?
Okay, yes, sir. Okay, first of all, I want to establish, like we said initially, that transfer pricing is not a form of tax. So transfer pricing has nothing to do with your tax liability. Transfer pricing is just a form of declaration. You declaring the transaction that has happened between you and your related parties. So section 17 of the transfer pricing regulation, section 15 of the transfer pricing regulation was that particular part that mandated every company to declare whatsoever transaction you've had with your related party. So section for something of this transfer pricing regulation now further stated that companies with less than 3 million
300, you might want to say?
300 million related parties transaction do not have the obligation to preparing what we call transfer pricing documentation. But companies above this threshold have to prepare transfer pricing regulation on the mandate of the Revenue Authority. So as a company, you need to ensure that you structure your book in such a way that your transfer pricing transaction does not meet that threshold. Because if your transfer pricing transaction exceeds that threshold, then you have the obligation to making a transfer pricing documentation at the mandate of any Revenue Authority. And also, if your transfer pricing transaction exceeds that threshold, then there is likelihood that the government might want to perform what we call the TP audit on you. So does transfer pricing affect your tax liability? Absolutely not. It doesn't affect your transfer liability as a company. I hope this answered the question.
All right, thank you very much. But to answer the other part of the question that says, how can company ensure compliance with transfer pricing regulation? So I think that question is coming from Said. Number one thing you need to establish is that, do you have or carry out any transaction with your related party? We had earlier identified what could constitute a related party. You might still have two or more companies that don't have common shareholding, right? But they might still be related, right? Let me give you an instance. If you have two persons in a family that has their own unique business, there is possibility that because of that family bond, certain transactions which they may carry out. What are some of these transactions? They may sell to each other. They may borrow money from each other. They may purchase from each other. This set of transactions that is potentially possible for them to carry out must be done as though they don't know each other at all. the prices at which they will have carried out these transactions with a non-related party should be the same price they should have transacted it with each other. Let me make it much more elaborate. If I am selling laptops and a friend company has approached me for purchase of those laptops, if each of those laptops is 500,000 naira, if I have sold that particular laptop at a value less than 500,000 naira, which is different, which is not in the same way I will have done for entities that are not in any way related to me, then it means that what has taken place is not, that transaction did not take place at arm's length. Therefore, there is potentially transfer pricing risks. Though that sort of transaction fits in very much well in financial reporting. Taxation did not emphasize those sort of issues, but experience has shown that when they analyze extended, not accounting relationship or family ties between certain company, they may eventually still identify potential risks. So you must be able to identify, have we in any way carried out transactions with parties that are related to us? If the answer is no, then it means continue, you don't have transfer pricing exposure, right? What could most likely have occurred is that you give a general discount to your customer, and that you have done without any sentiment. Everyone across board is eligible to that discount, so that doesn't constitute transfer pricing risks. But if you have parties that you have discretionally, and it can be established that you have a tie with them, whether family, friends, or even common shareholding, then that constitutes a transfer pricing risk. They are not saying you should not do so wish, but what the law is saying is that, what the regulation is saying is that you must be fair in your dealings. So to test that fairness, number one, you are expected to file your transfer pricing returns alongside with your CIT returns, right? That can be filed separately anyway. There are different platforms for which that could be done in Nigeria, in line with FIRS regulations, right? So you must be able to establish that I have that relationship. If you have that relationship, the next thing is you must file. So if you want to file, what are those things you must file? You must file the declaration form, which we call the TP declaration form. We must also file what we call the TP disclosure form. But prior to you filing, what is expected of us as accountants? You must keep track of all these day-to-day transactions that are being carried out between your entity and its related entities. You must try as much as possible that these transactions are carried out as fairly as possible, right? Keep track of those transactions. You must document those transactions, right, in a document which we call transfer pricing contemporaneous documentation, right? But to ensure that FIRS is not overburdened with so much information, right, the TP Regulation 2018 has set a threshold that you should file without being called upon if the cumulative transaction you have done with your related party is as much as 300 million. Does that mean that if you have transaction less than 300 million, you are not obligated? Technically, yes or no. You are not obligated if you are not called upon. But if at any time FIRS so decide to call on you, even though your cumulative transaction is less than 25 million, you should speedily respond to that within 21 days. Otherwise, you'll be sanctioned. So that then means that for every organization that have potential transfer pricing risks, whether you have met the threshold or you have not met the threshold, you must keep your finances or your record in such a way that if the FIRS decide to call on you, you can respond to that call within that 21 days timeline. Said, I believe that has addressed your question. Maybe in future we can also there are so many things to talk about as far as the practice is concerned, but we try as much as possible to identify a month that we can go much more in details into what transfer pricing entails, especially as the need to filing that returns approaches in June. Maybe we might look at it alongside with corporate tax returns in June, right? Any other question from anybody before I continue on our trail of conversation? Any contribution from anybody based on what we have discussed thus far, or any question? Okay, while we await that to come through, let me quickly go back to Toluwanimi. Toluwanimi, you had earlier started a conversation on ISAF 450. Is there any relationship between this standard? Are you still there, Toluwanimi?
Yes, I'm here.
Yeah. Is there any relationship between this standard and ISA 700?
Yes, there is a relationship with it, which was
on that, please.
Okay, which was what I was trying to state earlier. Right, I was trying to explain that depending on the type of misstatement that has been gotten and the response we get from the management themselves, that can now give us an heads up or help us as auditors make our final decisions on what sort of opinion would be given in the audited financial statements. So there are some, how do I put it? There are some factors to consider in giving or in arriving at the audit opinion that will be presented in the auditor's report, right? And the misstatement also plays a part in that. So in a case where the misstatement that has been accumulated or evaluated by the auditor is given a maybe pervasive opinion, that means maybe you're not able to get the relevant information you need from the clients or from the management in this case, or maybe the evidences you've gotten are not sufficient and appropriate, then there will be a modification of opinion in that case.
All right, thank you very much. Let me quickly go to Martins. Martins, are you here? Vanessa Martins, are you here?
Yes, I am. Good evening. Good evening, everybody.
All right. Good evening, Martins. One of the areas that we also earmarked for this month is on HR matters, and the HR arm of the business has come up with a topic of discussion this month, which we have identified as impact of economic fluctuation in business and employees' morale. Can you briefly explain what this means to our audience, please?
Okay, sir. Thank you so much. We all know what economic fluctuation is, but to further buttress, economic fluctuation refers to the ups and downs in the economy, which can actually affect business and employees. So during this period, I mean the economic fluctuation period, consumers spend like little or low money, and which in turn leads to like a reduction in sales, leads to reduction in revenue for business, and also it can make businesses or employers to actually cut costs, and sometimes it can lead to even layoff because the company cannot bear the cost that they're actually having at the moment. So at the end of the day, it leads to maybe cutting costs or maybe terminating of some employees.
Hold it there first. I'm so sorry I had to cut you. Have a hand up for a while. I'll come back to you for you to continue that conversation. Adeyonyi, are you there? Olumide, I saw your hands up. Do you have a question, please?
Yes, good evening, everyone.
Good evening. Let's quickly take that before we continue.
Okay, please. I on the platform, the normal WhatsApp group, I sent a message there. I mean, as far as 1 week back, which is I don't know if it's not part of the topic for today, but I don't know if something is like can be shared on it, which is talking about the cybercrime. This thing that I mean, that is hard matter. What are the effects of it on the economic, or be it as a entity, or I mean as in economic growth of the country as a whole. So I want us, I mean, if you can help me to share more light on that, if it is not part of the topic. And from today's topic, I would like you to help me buttress on the issue of IAS 21. So if a little share on it, I would like, I mean, to hear more about IAS 21. Thank you. Just a little brief of it, so I'm not to waste much of our time. Thank you.
Okay, thank you. Thank you for the question. Even though the first question does not relate to what we are talking about today, but because you have bring it up, I will briefly talk about it. You will agree with me that that particular introduction of that levy is very debatable. And as of today, Central Bank has advise its subjects to suspend the administration or implementation of that particular levy. But in my candid opinion, what I just think is federal government is just looking for other ways of generating income, right? I have looked at the context of that revenue regulation, and in every manner, I am not in support of it. I'm not in support of it because comparing that particular intent with what is obtainable in other countries, the general public should not be made to pay for cybersecurity. Cybersecurity is a responsibility of every organization and individual, which we should be aware of, and the need for us to protecting ourselves. However, on the side of the government, what is expected of them, just like what is obtainable in the US, in the UK, in Canada, and most other countries, is for the government to put in place framework that will ensure that acts of cyber attacks are well controlled, and where any culprit is identified, there are definite punishments given to them to discouraging that act. And let me give you further clarity on that. You have anything, what we call cyber is any act at all that occur online, right? Whether you transact online, there is a theft online, there is a social engineering, there is phishing and all that. As long as any activity is carried online, it is said to be cyber. Then security then means we have to protect ourselves. Organizations that carry out activities online need to put in measures to guarantee that protection. If you're using a bank app, it is the responsibility of the bank to ensure that that platform is as conducive enough for that very business as possible. That is the primary idea around cybersecurity. Cybersecurity has taken a step further because it's something that most countries across the world now are paying attention to. And why? Because business is going digital. Most activities of businesses are done online. And as a result of that, there is need to improve the protection of the cyber space. That is the whole idea. But I don't see any reason why the federal government should now impose such levy on anybody. I personally, my personal opinion, I don't in any way agree with that. I don't know whether that addresses your concern.
It's okay, thank you.
Yeah. Much more later on, if time will permit us, because of the relevance of this topic, we may do a session that could expose people to the need to be cybersecurity conscious and why that actually relates to our function as accountant, especially if you are carrying out an aspect of accounting which we call forensic accounting. Right. We'll discuss much more later if time will permit us, but of course not today. Then the second aspect of your question, if I get it right, is relation to IAS 21. Am I right?
Yes.
Okay. The whole idea about IAS 21 is to bring guidance around how we report transactions that are done in various currencies, right? It emphasizes the Nigerian environment, not only in Nigeria but across the world. It is expected that financial reporting must be done in the currency of the country where that particular company is resident. For example, if you have KCP in Nigeria, the financial report of KCP should be done or should be expressed in Naira because that is the currency of that nation. If you have KCP in Ghana, then it means the financial reports of KCP within the Ghanaian reporting jurisdiction is expected to be done or carried out in that very currency. Does it mean that if KCP as an establishment has clients that want to pay it in other currency, especially dollars or pounds, does it mean that the organization will now say, no, I don't want that very currency, all I want is Naira? That is not so. So that is why the standard emphasizes that transaction can be done in any currency. But when you are reporting, you must report in using your presentation currency. But the transaction that you have done, the currency at which you have carried out that very transaction, whether Naira or any other currency, is called the functional currency. It also gives you guidance around if your functional currency is a different currency from your presentation currency, how do you translate it into the presentation currency? There are various guidance on that. I'm still coming back to Alex on that. If we discuss things like the spot rate, the closing rate, and the likes, we're still coming back to that. So that's just a brief or a tip of an iceberg on that. Are you okay with that, sir?
Yes, thank you so much.
All right, sir. I also need to stress this, that within the ambit of the limited time for this section, we may not be able to address all the things that is expected of us to have, that is expected of everyone to know. But we have drawn your attention to some of those salient things. It is then you are then encouraged to read those epistles that we have written and also make more discovery by picking each of those standards on their own and dig much more further. Then if you have any areas of contention, either through our WhatsApp group or through our social media, especially the LinkedIn, we can take the conversation further. But if it is something that is very pertinent, especially when it relates to your work and you need a second opinion, you are free to ask any of my associates here or even call me directly. I will definitely create time to addressing those concerns. Then Timothy, once again, apologies that thing was not addressed immediately when you asked. I'm so sorry for that.
It's okay.
All right. Martins, back to you. You are trying to make a point, but I don't want us to digress too much. I want us to actually address the parts that relates to staff. It is very clear for everyone in Nigeria. Martins, are you there, ma?
I'm here, sir.
All right. It is very evident amongst everyone in Nigeria today that most definitely the purchasing power of what everyone or most people are earning today has drastically reduced. What sort of encouragement would you give to employees as a way to potentially increasing their earnings?
Okay, sir. So, encouragement to give to employees or employers, sir.
Employees. Let's start with employees first.
Okay, so first of all, we have to talk about transparent communication. First of all, transparent communication. You have to be open to your employer, letting the person know that, okay, this is the issues and all. So number one is actually transparent communication from the employer, transparent communication, letting them know that, okay, this is why there is a reduced cost, or this is why some rewards or bonuses are put on hold or on pause.
No, you didn't get my questions. Because of this gathering, most people here are most likely employees, right? And that's why I want that conversation to starting from there. What advice as an HR person will you give to employees as way to managing their income within this period, and what could they do to potentially increasing the earnings? If you want to think about that, I can give you some time to think about that. I'll come back to you. Alex, are you ready? Are you there? Please, for the audience, please still keep your questions coming. We have discussed quite a number of things, and I know, Alex, are you in transit? And I know there are quite a number of burning issues you would want to either contribute or ask questions about. Please keep the questions coming. It appears where Alex is, there is a little noise there. Abiodun, let me come to you on the effect of Abiodun, are you there?
Yes, sir.
Yeah, on the effect of foreign exchange on transfer pricing. What are the various methods that the transfer pricing recognizes when you potentially have a transfer pricing risk?
Okay, what are the various methods? You mean the transfer pricing method? Or...
Exactly.
Okay, so basically we have two types of transfer pricing method. We have the traditional type, and we also have the transactional type. So for the transactional type, we have what we call the cost plus method. So the cost plus method is when the controlled party ascertain the cost, what is the cost to them, and then put the margin on top of the cost. It's the regular cost plus method we all know. We also have what we call the control pricing method, the COP, yes, the control pricing method. So this is comparing the price at which you are transacting within controlled party with the price at which that particular same transaction would have been done when the transaction is uncontrolled. That means comparing the price at the controlled transaction with the price at the uncontrolled transaction. So for the transactional method, we have what we call, to have with in the traditional method, we also have what we call the resale price method. So the resale price method has to do with checking the price at which you would have sold to an independent parties. That means checking the price of that transaction at full arm's length. So full arm's length, we refer to full arm's length as the price at which you would have done that same transaction to an independent person. So for the transactional net method, we have the transactional net margin method. So for the transactional net margin method, now you are comparing the margin that would have been gotten on that transaction with a controlled party with the margin that would have been gotten on that same transaction with an uncontrolled party. So you are comparing the profit as a taxpayer. You are comparing the profit that you would have gotten from that transaction with your related party with the profit that you would have gotten from the transaction with an unrelated party. And lastly, we have what we call the profit split method. So the profit split method is talking about both parties coming together and splitting the various profits, costs, risks, and everything associated with this with the transfer pricing method. So apart from all of this method I've made mention, we also have a particular pricing method we call the APA, that's the advanced pricing method. So according to TP, the 2018 transfer pricing regulation was actually the one that bring into board what we call the APA. So this APA, which the full meaning is the advanced pricing method, is all about talking about the fact that you have an agreement with the tax authority. So if none of the pricing method I've made mention initially works for you, you can actually have an agreement with the tax authority for you to define specifically the method that works for you. So the what's it called now? The tax the FIRS in question will help you in analyzing the risk, the various benefits that is supposed to come out from the transaction, and come up with a suitable pricing method just for that your transaction alone. So those are the
Thank you very much, Abiodun. Thank you for well analyzing that. For the benefit of every accountant in the house or even business owners whose operations might be technically linked to this, Abiodun has given an heads up on various methods that we can use in pricing those transactions that are TP exposed. And I would like to pick, because of time, I would like to pick at least one and espouse that further. She made mention of one of the method, the transitional method, which we call the COP, comparable uncontrolled price method. So say, for example, I have company A, as Abiodun has earlier referenced, and company B. Company A is has ownership interest in company B, therefore they are related. Company A renders services, right, to company B. Company B sells computers, right? If company B desires to sell computers to company A, the price of each computer is 500,000 naira. That is the price it will have sold it to any party which is not related to it. So what comparable uncontrolled price method is saying is that the price you will sell it to company A will be the price which is uncontrolled. The uncontrolled price earlier is 500,000 naira that you will have sold it to any party that is not related to you. So that comparable uncontrolled price is that price that you can compare with transactions you have done with parties that are not related to you. Therefore, that should be the established price that you should sell to your related party. Otherwise, we will say that that very organization has not done the transaction at arm's length. I believe this addresses make us understand that. I wish to give more illustration, especially on other methods, but time will not permit us. Is Martins back?
Yes.
Okay. Somebody raised hands before I give you the go ahead to talking. Olumide, you raised your hand before. Do you still have any question you want to ask, or we can go ahead? Timothy, are you there? Okay, maybe that was a mistake. Okay, Martins, go ahead for the question.
Okay. The question asked was advice to give employees as ways to manage their income when economic fluctuations arises. Number one is create a budget around your income so that you do not overspend, so that every now and then you can always have something to actually fall back to. And what I would actually advise, after creating a budget, you have to plan well, plan your savings well, so that you don't go from one lending app to the other to start borrowing loans and all that. It can be very bad. So another thing is to skill up. Skilling up is very important. If you skill up, you are open to more multiple streams of income, multiple stream of income, because if you have a particular skill and you actually work on that particular skill, at the end of the day, it actually works for you, because when economic fluctuation happens, you tend to utilize your skill and make more money, so that you don't always depend on your salary. Another thing I'm going to say is build an emergency fund, so that when situations like this happens, you can actually go back to that emergency fund, in quotes, that you've actually built or saved up over time, and it can actually come in handy. And lastly, I'll say is saving. Saving is actually very, very important. No matter how little or how robust salary you earn, saving is actually important, so that when situations like this arises in the future, you can always have something to fall back to. All right, that's all.
Thank you very much. I would like to conclude what she said with a philosophical saying that says that you don't save what is left out of your spending. You save from your actual income before you actually spend. Time is not really on our side. I would like each and every of the speakers to give us their closing remark if there is no question from any other participants. But before I take on them, I have somebody here. I want to be double sure is the person that's the face I know. Bolanle Zainab. Are you there? Bolanle Zainab? Or maybe she's not there. Are you there? Okay, Makide, go ahead. Your closing remark.
All right, sir. I would like to thank everybody for attending today's session, and to future auditors out there, right? It's important, like we've also emphasized earlier, that we are conversant with every standard that governs our activities, so that we are able to, in a way, defend whatever position we are putting forward to our clients. So my closing remark is just that let's stay updated with happenings in the field or in the industry, and keep ourselves abreast of every issue and every topical matters that happens. So thank you.
All right, thank you very much, Nimi. I don't think Alex is here, but I will seek Cousin's indulgence to giving a closing remark on behalf of accounting services. But before I come to him, Abiodun, can we have a closing remark from you, please?
Okay, so I would like to end by saying this, that every taxpayer should, it is necessary for every taxpayer to identify where you have TP rates, because there are various tax regulations out there that does not balance you paying in time, but the penalty, if not being compliant, can be very, very adverse. Penalty for TP, if not complied with, is 10 million in the month of default and 10,000 for every days of default. So it is necessary for you as a taxpayer to be conversant with every regulations guiding your industry. Thank you.
All right, Bjorn, before you go, there is something that also still goes alongside among the BEPS projects, that is the CRS. Just for the benefit of those that might be, whose business or employer's business may be impacted by that. Can you give a little brief about that and they need to quickly comply before the timeline? CRS, Common Reporting Standard.
Okay, so Common Reporting Standard CRS is basically filing done by people in the financial industry, investment industry, insurance and the likes. Basically, for people staying outside Nigeria, let me start by saying that for every citizen of Nigeria, you are being subjected to tax based on your worldwide income. So that means if you are a Nigerian resident in another country, you are being subjected to tax based on the income earned in Nigeria and outside Nigeria, because you are a citizen of Nigeria. So a way government can track income earned by Nigerian not resident in Nigeria is by the CRS reporting. So the CRS reporting is basically for companies that deals with accounts, that maintain accounts for people. So the CRS reporting goes around them filing reports about account balances owned by people resident in Nigeria but are not citizens of Nigeria, and this reporting is being filed by industry like the financial industry, like I made mention of, investment industry, insurance, basically any industry that deals with holding accounts on behalf of people. So you are obligated to filing the CRS industry, and the deadline for filing this return, just like the TP returns, you are not paying anything. It's just basically a declaration, and the deadline for filing this return is May 31st of May, which is tomorrow. But for this year, there was a breakdown in the portal used in filing the return, and the government have extended it till 30th of June. So that means you still have from now till 30th of June if you fall within this industry to file this return.
Thank you very much, Biodun. So as she has said, as you prepare for your corporate tax returns for organizations whose financial year ends in 31st of December, open to filing the returns on 30th of June, make sure that you look and analyze your financial statement to determine whether there are potential transfer pricing risks. And if there are, and it is up to the threshold of 300 million, it might be good for you to seek the advice of your tax consultant such that that will be regularized. Even if your related party transaction is not as much as 300 million, it doesn't mean FRS at any time may not call on you. So put your numbers and your records together to ensure that you are rightly positioned to discharging that responsibility. And for those who materially are exposed to transfer pricing risk, it is also, filing the returns is not enough, but maintaining and keeping your TP contemporaneous documentation is most important, because when the government so requests for it and you're able to providing it, the fine is 10 million naira, as Biodun rightly said. 10 million naira on a minimum for not being able to provide the TP contemporaneous documentation, 10 million naira for not being able to file the TP returns on its own. So you can imagine what you will have done without attracting any extra penny as taxes. Your inaction may then result to that enormous sum. Please, let's try as much as possible to do the needful. And for those organizations that qualify as reportable financial institutions, which Biodun has identified as banks, any organizations that keep the treasury or the fiduciary responsibility of individuals that are not Nigerian, but maintains accounts with such organizations in Nigeria, such as the commercial banks, the investment institutions, the MFEs, microfinance bank, MFBs rather, the insurance companies and the likes. Any organization that keeps the money or treasury of every individual, as long as you have among your customers' portfolio persons or organizations that are non-Nigerian, you are obligated to filing the common reporting standard. So do well to reach out to your consultant, and if you have any question, please feel free to reach out to us. Kasim, would you mind to giving us a closing remark on behalf of the accounting service arm of the business? Is Kasim there? Okay, Alex is back. Good. Alex, you have the floor.
Yes. Closing remark to the audience. So for IAS 21, the impact on various businesses these days is on the high side due to the volatility of the market. So my advice to every working business or every business in operation, that they should take note of whatever spot rate is being used in the course of them transacting with their day-to-day activities. That is, they should ensure proper documentations of these rates, because issues may warrant that you have to show evidences for these exchanges that you carry out, especially if you do that if you do it through BDCs, where they change. So it's expected, so that you can also be able to account if there are gains or losses in the course of you trying to carry out this exchange. That's my advice to everyone. Ensure proper documentations of every FX transactions, and also in course of reporting, you should also take note of the effects of this foreign exchange in the course of you reporting.
All right, thank you very much, Alex. Martins, over to you, Ma. Any closing remark for the audience, please?
Okay, economic fluctuation can significantly impact employee morals. But in order to avoid all this, employees are actually advised to create a budget and track their expenses, so that when this economic fluctuation arises in the future, they are not caught unawares. Thank you so much.
All right, so all of our audience, we want to thank you for being part of the success of today's episode. Thank you for creating time to attending this. But beyond the time you have created, we encourage you to look inward on how you can transit this time to real value to yourself. Look at some of the context of our discussion, make further discovery about it, and let it impact on your competence. You agree with me that the more value you bring on board in wherever you are working, the more likely you will be indispensable for that organization. And by in the long run, that translates to more money or more income for you. We wish you all the very best, and do enjoy the rest of the weekend. Happy new month in advance. The couple of days will be in July. Wish you all the very best. See you in our next episode. I remain Adekunle Cole from KCP. Thank you, everyone.
Thank you.
Thank you very much.